Good morning, traders. Welcome to the week ahead preview with me, Aaron Hill, Head of Research here at FPMarkets. Now, what an absolute beast of a week we had in the markets with increased volatility seen across all major asset classes. I mean, take a look at the VIX here. This is a volatility measure based on the expected market volatility for the S&P 500. It can be used as a tool to enter long and short volatility as a product, hedge portfolio exposure, and of course assess overall market volatility. Now, as you can see here, we are still trading at elevated levels following a spike through this resistance between 37 and 35 to a high of around 40. This support area on the S&P 500 daily chart between 4,892 and 4,960 held well, combined with the VIX testing a very familiar resistance. Market participants were talking about this 35 area on the VIX as a potential mean reversion play. And as you can see from the reaction from this support area, it has worked out very nicely with the S&P 500 now trading north of resistance between 5,190. Now, in the equity space, we did see US indexes teeter in and out of bear market territory last week. But ultimately, as you can see here, they all finished higher across the board last week. Moving over to spot gold. I mean, what can I say about this market other than it chalked up a strong one-sided move to fresh all-time highs of 3,245. I am still a dip buyer in this market until we reach this 1.618% Fibonacci projection ratio on the monthly time frame at 3264. Now, the reason I do see this as a potential headwind for the yellow metal is given where we are trading on the RSI at the moment. I mean, we are considerably overbought, and we are testing a resistance between 87.31 and 82.20. Now, this resistance boasts historical significance as far back as 2006. And each time this market has tested this area, we have seen the yellow metal print a correction. We did see a mild correction form here. So, I mean, but I do expect given that we are still driving higher into that resistance area, I do expect that we will see gold roll over and print a mild correction in the near future. But until we reach that 1.618% projection ratio here, as I said, I am a dip buyer right now, and I will be watching these support levels on the daily time frame very closely at 3,148. This is an inverted head and shoulders. An inverted Quasimodo resistance turn support at 3,148 and a basic demand area between 3,000 and 3,058. Now, this morning I also read that Goldman Sachs has issued another round of bullish forecasts for the yellow metal. And I believe their reasoning is that with the stronger than expected central bank demand and the metals role as a hedge against recession and geopolitical risks, they are now expecting gold to reach 3,700 by the end of this year, with prices with expectations of 4,000 by mid 2026. Of course, time will tell on that one. Now, in terms of where we are on the dollar index, the last week wrapped up with the dollar taking a real solid hit to the midsection. We were down 3% on the week. This was despite US Treasury yields rallying across the curve. Now, where I am technically on the dollar index, although we are testing support on the monthly time frame between 98.72 and 99.67, I am seeing room to the downside on the daily time frame here towards support of 98.58. So I do expect that we will see further downside in the dollar index until we reach this support, and this will be a key area for me to watch for potential buying pressure. As a note, the 50-day simple moving average is also fast closing in on crossing below that 200-day simple moving average. which is a death cross and can signal a longer term downtrend on the table. Here's death cross there, and here's what's referred to as a golden cross. So look, in terms of look, the bond markets will be very, very key to watch this week. As you just saw from the US dollar index, traders unwound dollar exposure last week, and this was amid Trump's back and forth tariffs, which have essentially threatened to undermine confidence in US assets and the economy. Look, while a 90-day reprieve has been granted to most nations, the escalating trade tensions between the US and China not only threaten global supply chains, but they potentially fuel inflationary pressures and weigh on economic growth. Now, the issue here with the bond markets is that in times of stress, you will often find that investors buy into safe haven assets like the US dollar and gold and treasuries. While gold has indeed rallied, the US dollar and bonds drop sharply. This is US Treasury yields here, guys. So when bonds drop, yields rise. So this is a strong rally to the upside in yields and a strong downside push in bonds. Also, take a look at this on the, this is a chart of the US 10-year yield and the US dollar index. Under most scenarios, a home currency will be, as you can see here, look, a home currency will be heavily correlated to yields. So if yields rally, the dollar in this case generally follows suit. But here we're seeing quite a strong disconnect here with the US dollar index strongly to the downside and US Treasury yields to the upside. And I believe this can be explained by simply the declining confidence in US assets. Now, on Friday, we also had Fed's Kashkari out saying, and I quote, recent market trends show investors are moving away from the US as the safest place to invest while Trump's trade war escalates. So where are we now in regarding tariffs? Now, the latest news according to the Financial Times, the White House exempted smartphones, laptops, and other devices from Trump's so-called reciprocal tariffs, including a 145% levy on imports from China. As you would expect, this has given equities a bid, with Asia ending higher across the board, and US equity index futures also trading in the green. I'm sure you'll agree, the tariff tail has been quite the ride. Following Liberation Day, this was earlier in the month, we saw Trump impose 10% baseline tariffs on all nations, and higher levies across about 60 countries, I believe it was. Then Trump staged a U-turn, pausing higher tariffs for 90 days and then applying a blanket tariff to all countries except China. While this did offer some relief and markets did show that relief in risk assets, the US and China continue to butt heads after Trump excluded China from that temporary halt and increased tariffs to an eye-popping 125%. I mean, that's just ridiculous. And these are on goods exported to the US. So, and then this follows China's 84% tariffs on all US imports. We saw an escalation of this in the second half of last week with China responding by increasing tariffs to 125% on US imports. And then I think it was then Trump imposed 145% tariffs on Chinese imports. I am getting quite lost with a lot of this, and I'm sure many are as well. But look, on Friday, we did see the Ministry of Finance, this is out of China, essentially state that they are now ignoring the US in terms of these tariff increases. Unfortunately, this tit-for-tat US-China trade theme is unlikely to be resolved anytime soon. I just do not see China backing down to the US, despite their problems that they have at home. And the Trump administration has, as I'm sure you're all aware, have been downplaying the market impact. So I think it's fair to say that uncertainty will remain high, and markets on on edge. Now, last week's macro slate revealed was quite interesting because it revealed softer than expected US inflation on both the consumer and the producer side. Though the market reaction was somewhat limited and did very little to slow the rise in Treasury yields, which you would expect after lower than expected US inflation data. It's also worth mentioning that consumer sentiment data was out on Friday from the University of Michigan and came in much cooler than expected, and inflation expectations surged. Again, very little market reaction seen from these prints. Now, for many traders across the world this week, despite a long Easter weekend ahead on Friday and Monday, and the focus remaining on tariff developments, the upcoming week does not lack in terms of the tier one macro drivers. In addition to updates from the European Central Bank, the Bank of Canada, and US retail sales numbers, all of which I will be touching on shortly, we also have inflation data from the UK, Australia, and New Zealand. We also have employment data from the UK and Australia, and we also have some Chinese data out as well. Kicking off with the US retail sales data here, as you can see, this is expected to land at 12:30 p.m. GMT. This is UK time, guys, so 12:30 p.m. GMT. And for March, on a month-over-month basis, we are expected to have risen to 1.4%. This is up from a 0.2% print in February. Excluding autos, we are expected to slightly tick higher to 0.4%, up from 0.3% in February. Now, what's interesting here is the estimate range. So for the retail sales month-over-month print, we have an estimate range of between 2% and 0.2%. This is according to the LSG data from Refinitiv. Now, on the ex-autos print, we also have a huge estimate range between 1.4% and minus 0.3%. So this is certainly numbers that are worth penciling down. So we are clearly expecting retail sales to jump in March. Now, this is something I found very interesting, a consumer checkpoint from the Bank of America, which is released every month. Now, I did highlight this point. The import content of consumer goods and services is substantial, raising the risk of price rises from higher tariffs. In the Bank of America data, we find some evidence that consumers were buying durables ahead of the introduction of tariffs. The evidence is strongest in auto sales, and this kind of supports that large jump we're expecting this month. For the month of March. We also have the Bank of Canada's rate decision out on Wednesday at 1:45 p.m. GMT. As of writing, we are expecting the bank. Bear with me, guys. There is around 11 basis points of easing priced in, which means that the markets are assigning around a 44% chance that the Bank of Canada will cut the overnight rate from 2.75% to 2.5%. It is around a 50-50 chance right now that the BOC will pull the trigger again this week. And bear in mind that the central bank has cut rates in its last 7 meetings. On one side, we have economic activity growing at an annualized pace. It came in at 2.6% in Q4 24. And we also have headline year-over-year inflation rising by 2.6% in February. And really, this suggests that the bank could hold the overnight rate at 2.75% this week. Note that we do have the March CPI inflation data hitting the wires on Tuesday. This is a day before the Bank of Canada makes a show. But on the other side of the fence, the Bank of Canada, like many other central banks, are working in uncertain times, and with that could opt to reduce its interest rate, given the uncertainty Trump's tariffs bring to Canada's economy. According to Statistics Canada, the country is a dominant trading partner to the US. With more than 75% of its exports sent to the US. So look, the country is quite vulnerable here. We also have the ECB out on Thursday, and just bear with me here, guys. The ECB is out on Thursday. I'm just trying to find where that is. There we go. Out on Thursday at 1:15 p.m. GMT. Now, the markets are pricing in. I believe the last time I checked, it was fully priced in. Yes, we're still fully priced in for a cut across all three benchmark rates this week. Now, a cut this week will, of course, bring the deposit facility rate down from 2.5% to 2.25%. Now, unlike in Canada, Eurozone inflation has continued to trend in the right direction. Inflation eased to 2.2% in March, and this is on a year-over-year basis. And this marks the lowest inflation rate since last year, late last year. Now, but on the other side again, although the European Union now face lower than expected US tariffs, the central bank is still expected to step in and shore up the economy amid risks to growth. Okay, so look, that's really it from me today. I think it's very important to bear in mind that, especially this week, given that lower liquidity, we have potentially have lower liquidity heading into the Easter weekend, and the attention, let's be frank, the attention remains firmly on tariffs for now. So how much of a market reaction we can expect from all the upcoming data we have on the docket is very difficult to estimate. As always, please like and subscribe to the channel for more videos. Thank you very much for listening and have a great week ahead.